In my last video, 5 times it's okay to retire broke, I tackled why it may actually be okay to retire broke. But in this video, I want to dive into why so many baby boomers and soon Gen Xers are retiring broke. Baby boomers were supposed to be the ones who would retire rich. They had everything going for them: rising stock markets, rising home values, and decades to prepare. So why are so many retiring broke or dangerously close to it? Let me start out by giving some statistics on this so it doesn't seem like I'm just pulling these things out of my hat. According to a 2025 Gallup poll, 70% of people ages 50 to 64 have retirement savings, while 63% of those 65 and older have retirement savings. The inverse is that 37% of retirees have no retirement savings, while 3% of pre-retirees have no retirement savings. All right, that just those are numbers from the Gallup poll, and I'm going to include a link in the notes so that you can check out the numbers yourself. What those numbers don't tell us is how much money people are retiring with. Is it $1, $100,000, $1 million? I had to go a little bit further to get that. For that, I turned to another source, which was the Employee Benefit Research Institute, EBRI. The statistics below are drawn from their 16-page report. It's a little dense, a lot of statistics, some of which I interpolated because the numbers don't exactly jump out at you. So here goes from their report. Among early baby boomers, now these are defined, if you're not aware of this, there's a breakdown between early and late baby boomers. The early baby boomers are considered those born before 1957 and those born after. It's been decided based on a number of factors that there is a dividing line in there. For the record, I'm one of the late baby boomers, so I'm into the poor group. The early baby boomers are the ones who had all the biggest advantages of the post-World War II era. So go the statistics. Among early baby boomers, 27% have over $100,000 saved for retirement. 19% have between $50,000 and $100,000. 31% have between $10,000 and $50,000. 12% have less than $10,000 saved for retirement, and 12% have nothing at all. So we can summarize this group by saying 73% have less than $100,000. I think most of us would say you need a lot more than $100,000. So the 27% number, if it's realistic, and there's no reason to doubt this institution, it's widely quoted, widely respected, 73% of the privileged class of baby boomers have $100,000 or more. 54% have less than $50,000 saved, and 24% have less than $10,000. Half of those have no savings at all. So that's a pretty depressing number there. Among Gen Xers, those are people born between 1965 and 1980, and the late baby boomers, those are the people born after 1957. 13% of both groups, 13%, have more than $50,000. 30% of Gen Xers and 43% of late boomers have between $10,000 and $50,000. 26% of Gen Xers and 20% of late boomers have less than $10,000. And finally, 25% of Gen Xers and 15% of late boomers have no retirement savings at all. We can summarize this group by saying 7%, well, I think that number is a little bit wrong. 87% have less than $50,000 saved for retirement, when 51% of Gen Xers and 35% of late boomers have less than $10,000 saved. All of those numbers are very depressing. Whether you have $10,000, $50,000, $100,000, it can be tough to scrape by, especially if you don't have a generous pension, generous Social Security, and everything basically lined up financially for retirement. Again, that information as far as the savings numbers is from the Employee Benefit Research Institute. The link is in the notes below. Now, we're not talking about people who never worked or never saved. They're ordinary, hardworking Americans who did everything right and still either had no money by the time they retired or ran out shortly after. In this video, I'm breaking down 5 specific reasons why so many baby boomers are retiring with little or nothing, and what this means for your retirement planning. That's the most important part. For the record, this is not about blame. I've known a lot of people in this situation, and there's usually a background story that a lot of people who are more successful don't care to hear, but everybody needs to hear it if we would take some time. This is really about understanding what really went wrong so you don't repeat the same mistakes or assume that you're doomed if you have gotten to this point where you feel like you're broke or close to it. And I'm going to define broke as not only people who have no money at all, but people who are close to it, just not a generous amount of savings, and meaning they have to rely on other financial resources. That could be a tough position, especially as you get older. So reason number one, many underestimate how long retirement will last. This is actually a good news, bad news scenario. The good news is we're living longer. The bad news is we have to provide for longer retirements. So where retirement used to mean providing for 10 to 15 years of kicking back and relaxing, now it could mean 20, 25, 30 years or more. A person could retire at 62 and live another 35 years. They've got to provide for those years. Longevity risk is a silent killer of retirement plans. It keeps us alive longer, but it's the death knell for our retirement plans. Also, kind of a silent factor here, the impact of inflation over decades. So we know what it could do over just the last 5 years since the pandemic. But let's go out 10, 15, 20 years and think back what everything cost 20 years ago versus today. Imagine what it's going to be in 20 years. That's a major, major factor, and it's not figured into the plan. The key takeaway is we have to plan for longer lives, and that actually matters maybe more than big retirement plan balances. Reason number two, inflation. I touched on this a bit. I want to go into more detail here. I'm of the opinion that the popular CPI that's always quoted in the business news understates the true level of inflation, and it has for decades. The government is always reporting inflation at 2 or 3%, and I think most of us know it's substantially higher. Exactly what it is depends on what your mix of products and services are in a typical year. Some expenses like housing and healthcare have just shot through the roof. They're not affordable to average people anymore. Inflation hurts in two ways. First, it reduces the ability to accumulate savings while you're working because you have to allocate more money to basic living expenses. And then the second thing it does is it raises the cost of living once you retire, so you need more money. So it's hurting you in both directions. There's no easy way around this other than to make more money, that would be the simple answer if only it were possible for most people. A lot of people who retire on a shoestring and have no plan to deal with higher prices in the future. It's a ticking time bomb. You've got to find some way to deal with higher prices. That's going to mean either steadily cutting expenses or steadily increasing your income even a little bit. Retiring early magnifies the inflation problem. Once again, you've got more years to prepare for and fewer years working to do it. So the impact of inflation is going to be greater the earlier you retire. Reason number three why baby boomers are retiring broke: overestimating Social Security. Either through ignorance or willful neglect, I've got to say that many baby boomers assumed that Social Security would be enough to provide for their retirement. I've actually heard people prior to retirement saying exactly that much. And then you get something totally different once they retire. Oh, I thought it was going to be more. I got screwed. No, you can go on the Social Security website and you can set up your own profile there. You'll know exactly what you're going to get years before you retire. So that'll help you to plan. I recommend that you do it. You can just go to the Social Security website. You can go to the benefit estimator. It'll tell you approximately what you're going to get. I did that for several years before I began collecting. The number was right on the money. So there was no surprises there, and I actually thought that the benefit was quite generous, considering it's only Social Security. Understand, Social Security doesn't replace all of your income once you retire. Typically, it replaces about 40% of your income, and it'll be less if you are a high-income earner. If you're making $75,000 a year, you probably figure around $30,000 thereabouts, maybe a little bit more. If you're making $150,000, it's going to be less. Another problem with Social Security is claiming benefits early. That permanently reduces your benefit. So if you collect at 62, your benefit is going to be reduced by 30% from your full retirement age, which is now 67. So that's a big factor. If you were going to get $2,000 at 67, you'll get $1,400 at 62. And then finally, we're getting back to the inflation problem again, the COLA adjustments on Social Security. I'm glad they're there, but they're tied to the watered down CPI. So if they're giving you a 2% increase for the year, but prices went up by 5%, you're really falling behind by 3%. And remember, this is multiplied over the decades of retirement. So the situation gets progressively worse the longer you're on Social Security. Reason number 4, another big one, the disappearance of pensions. If you go back to the 60s and 70s, it was very common for people to have pensions, even people who worked in the private sector. It's still popular among people in government jobs. What's happened over the years has been a shift from the defined benefit pension plan to 401ks, 403bs, etc. And those are basically self-managed plans. You have to fund them yourself. You also have to manage it yourself. And that requires discipline, investing knowledge, and consistency. And this is going to sound like I'm making an excuse for people, but not everybody has those qualities. Some people have absolutely no interest or aptitude for anything financial. It's very difficult for such a person. You could say, well, just put all your money into an S&P 500 index fund. What happens if, like during the 1970s, that goes in reverse? Or that whole period from about 2000 to 2010 is considered to be the lost investment decade. So if you had all your money sitting in an index fund, you didn't necessarily ride it out without having any kind of reduction in your savings. In addition, a lot of people had to cash out or borrow from their retirement plans because of layoffs. Not unusual when you're in a situation like that. You're in survival mode. That's not anybody's fault. Everyone says, well, you should have saved that money or rolled it over. But if you're making $1,000 a week and you go on unemployment at $400 a week, you can only sustain for so long on emergency savings. And if your unemployment goes on for several months, you're probably going to have to tap that 401k. It's just the way the world works. There's no future if you can't get through the present. So I don't blame anybody for doing that, as long as they're not doing it to take a vacation or buy a new car or something frivolous. And then finally, in this area without pensions, it exposes workers who may not have some financial sophistication to deal with market volatility, which is crazy. I am a stock market investor myself, and it's a lot of times it's like a roller coaster ride. Mentally and emotionally, you've got to be prepared for that. You also have to have strategies to deal with it. I know some people say, well, just put your money in the market and sit and wait forever and you'll have nothing to worry about. I don't agree with that, especially once you get into retirement. A lost decade just before retirement or in the first decade of retirement can be an absolute disaster. It's referred to as sequence of returns risk. I'd recommend looking that up. If you think that market volatility is not a problem and all you have to do is hold through the decline, look up sequence of returns risk. It affects a lot of people where the market goes down just right around the time they retire. Finally, reason number 5, unstable employment. I've already touched on this. The old concept of employment for life, particularly in the private sector, is gone. It still often applies in government jobs, but in the private sector, corporations, small businesses, it's just not there. I think we all know it. We don't need statistics. It's a reality that everyone lives with. It has to do with employer cost-cutting fever. Jobs used to get cut mainly during recessions, but then they'd be restored when the economy began to improve. Now, job eliminations have become a permanent business strategy. They're happening even when the economy is good. And it's a lot of the concern about AI. It's going to replace a lot of jobs. So if anything, we could expect that there's going to be even more job losses in the future as companies try to cut back. Unfortunately, for a lot of businesses, since we today have a service economy, the biggest expense they have are salaries. And that also includes benefits, payroll taxes, etc. So cutting jobs has a disproportionate positive effect on the bottom line. There's a lot of incentive to cut jobs. Also, unpredictable employment puts an end to the steady climb up the salary ladder. So if you're on a job now and you're making $50,000 a year, you have no guarantee that you're going to double that in the next 5 years. You may lose your job in 2 years and have to take a pay cut. You might be making less money now, or less money in 2 years than you're making right now. That's a possibility that previous generations didn't have to worry about. Once again, many laid off workers are forced to liquidate retirement savings just to survive unemployment. So let's talk for a minute about who this doesn't apply to, because obviously it doesn't. There are plenty of people out there who are very well off in retirement. You've got boomers with traditional defined benefit pension plans, especially those who work for the government. They're sitting pretty with those. If you've got paid off home, non-retirement savings, and you're able to maintain low living expenses, you'll be able to sail through this. So that's really what everybody has to be going for. Although, again, most people don't and won't have pensions, as well as the fact that they may not be anywhere long enough to get a vested pension. Also, people who have built strong income streams. I like the idea of multiple income streams in retirement. That's what I've got going now. It's better than relying on just one or two sources. If you got 3 or 4, you got things to fall back on. Plus, it's easier to deal with inflation and with unexpected expenses. You're not relying on savings for everything that happens. And then, of course, people who are willing to adapt their lifestyles to reduce financial conditions. It's something I think going forward we're all going to have to be prepared to do, even people who are well off. Final thoughts: retiring broke isn't a failure. It shouldn't be seen as a failure, but it should be viewed as a warning sign, as a sign to get going in a different direction. Emphasize alignment more than anything else. That means getting your expenses, your income, your savings, your healthcare costs, and your lifestyle all in balance. That's really a big key. It could cover for really a lack of a lot of retirement savings, but you have to get them all firing on all cylinders to get it all working. Are you one of the baby boomers who retired broke, or are you approaching retirement and worried that that might be your fate? What are you doing to deal with it or to prevent that outcome? Leave your comments below and let's chat about it. I might even turn your comment into a future video. If you like the video you're watching, hit the like button below and subscribe to the channel. Thank you for watching.